Hey everybody, Dave here, Hidden Freedom Investing. In this video, I want to go ahead and go over all the purchases that I made this week. It was an expensive week for me, and basically, if you hadn't seen the video I did 2 weeks ago, I will link it right here, and go ahead and take a look at that video if you have not seen it already. It's a 2020 goals video, and in that video, I kind of discussed that I was going to be starting 2 new dividend portfolios. I had X amount of dollars in there that generated me, $1,000 for 2020. And I had a goal to increase that portfolio this year to get me up to the $2,000, which was my goal for the dividend. So let's go ahead and take a look at the purchases and the portfolios. So let's go ahead and get started. So before I put you into the portfolio, I just want to let you know that some of these positions I dragged over, is it dragged or drugged? Dragged over from Interactive Brokers, basically a retirement account that I had over there. And I was kind of looking for a new broker because Interactive Brokers doesn't do fractional drip, and because it doesn't have a lot of capital in there right now, and the positions are kind of spread out. It's not fractional drip Interactive Brokers, so I figured it was a good time to move over to something like Schwab. So I, asked All Good, can you generate a referral for me? And she did gladly, and I do appreciate that, All Good. And so I opened up a retirement account at Schwab, took those positions in from Interactive Brokers, and then also just about 2 weeks ago, I went ahead and opened another brokerage account with Schwab. That is a taxable account. In that video that I did 2 weeks ago, the 2020 goals video, I said that I was going to be building these 2 portfolios up over time. They both are going to have about 30 to 35 positions overall, and the exact same positions. So that's kind of just the little bit of a backstory on what I was going to do with these portfolios. So this week I purchased a ton more positions, doubled down pretty much on the existing positions, bought 13 new ones, doubled the account size, and increased my dividends. So let's go ahead and do my portfolio reveal. Let's get into it. So we are logged into Google Sheets here. What we are looking at is basically both of my dividend portfolios, both Schwab accounts, in one view. All right, so what that means basically is if I have 10 shares of Leggett & Platt showing in here, then most likely I have 5 shares in one account and 5 shares in the other account. Now that's not always true. Like Altria here, for example, has 9, so it could be 5 in one and 4 in the other. Now that's not always going to remain the same, just because one account's going to grow faster than the other, just because I have a lot more capital outside of my tax-deferred accounts. So the tax-deferred account will be growing a little bit slower, but that's okay. I kind of have plans to grow that account, over time, next couple years. We'll grow it up, I think, to 200,000, I think is what I said in the video, the goals video. So, but for my taxable account, I see that account going up to about 500,000 to 700,000 as my notes bleed off. If you haven't seen my notes, my real estate notes, it generates a lot of income for me. Go ahead and take a look at that video here, and I'll link it at the top there. As those notes bleed off, I will be adding more capital to the tax-deferred Schwab account, and then updating the spreadsheet here. So the only caveat is realty income. That one is a REIT, so it doesn't pay qualified dividends. So that is basically in my tax sheltered account, 20 shares. That is only in that account alone. So if I add to that account, it's only going to be in the tax deferred account most likely. I don't know if I'm ever going to add it into the taxable account or not, but for now it is only in that one account. So these are the stocks that I have in my 2 portfolios. Right now, all of these stocks, which is there's 30 of them total, because we start on row 2 and we go up to 31. So there's 30 stocks total in here. There's 30 in one account and 29 in the other. And right now they are sorted off of lowest portfolio value to highest. The biggest position right now is Johnson & Johnson. So this week I basically doubled down on this portfolio and added about $25,000 across both portfolios in total. So, in that video, my 2020 goals video, so I was making about $1,000 of qualified dividend income. I had a goal for 2020 to double that at minimum. So here we are all the way up to 1681 because I doubled the portfolio size. Would have been nice because I doubled the actual portfolio size to been doubled the annual income, but I had to get in some lower dividend paying stocks. So, that's just the way it goes when you need to get diversity out of it, right? So, my recent pickups just this week, I picked up Leggett & Platt, I picked up Archer Daniels, Caterpillar, Wells Fargo, ADP, Home Depot, Air Products, PPL. Shout out to Gen X for suggesting that one. Goldman Sachs, Clorox, Travelers, Kimberly-Clark, Colgate-Palmolive, Microsoft, Walmart, Procter & Gamble, McDonald's, and let's see, JP Morgan, and that's it. All the rest I already had, I carried over from last year, and I transferred those basically over from my Interactive Brokers account. And some of them I had actually from the beginning of last year as well. Like I had T for most of all of last year. I had ABBV early from last year when it basically dipped, and I picked it up at a really good price. It was up over 30 to 35% on that. So I actually dumped a little bit of it as well. Part of the issue is I have a lot of consumer staples, and we are going to look at that here in a minute. If we sort off of basically the sectors here, look at all these consumer staples I have. You know what I mean? So, consumer discretionary, consumer staples. I'm very heavy in consumer staples right now. That's, I don't know what to say other than these are really good companies right here. So I want to have these in my portfolio. What I'm going to do is I'm going to adjust the allocations as I build these out and, kind of get those in spec as we grow them out, but I need them in my portfolio. So the other one that I'm kind of maybe a little heavy on right now is maybe utilities, but I'm okay with that. They're pretty solid companies, and I don't mind picking up even a couple more of those, but I'm very light on information technology right now. I got Microsoft here, which I just picked up. I only have 10 shares right now, $1,600. But ideally, I want to pick up a lot more Microsoft as well. I don't really, consider ADP a technology company, but that's what it is. So just for giggles here, basically my biggest dividend producer is ExxonMobil, and I kind of a little heavyweight on ExxonMobil at this time. If it ever gets up to what I paid on that, I'll probably dump about $1,000 out of this and throw basically $1,000 into Chevron, kind of equal those out a little bit, just to kind of reduce a little bit of risk. And I don't like to have a lot of risk in just any one stock, so I kind of like to spread my risk out if I can. Basically, before I scroll over to the right here, I just want to show you what's on my watch list. These are the stocks on my watch list right now. Basically, I added a bunch of these to the watch list today. So I basically added Stanley Decker, Grainger, Cardinal Health, Medtronics, Abbott, Aflac, Cincinnati Financial, Cisco, Hormel. Let's see, I got Philip Morris in there, and there's a reason why, but, and the rest, let's see, that's GPC, which I think is the same thing as Napa, if I'm not mistaken. And all these were basically on the aristocrats list, and you can kind of see right here, if they're aristocrats, so they're basically 25 years or more, and how many recessions they survived. In the first year they started to pay out, the consecutive payouts. So, Duke and Dominion are not aristocrats right now. They're quite a ways away, like 10 years away. What's another one here? Cardinal Health is not really there either. It's not too far off though, 2 years off. So, Abbott Labs, I don't even know why I have that one on the list. Just because I have these on the list, doesn't mean I'm going to buy them. I'm always looking for possibly more diversification if I can get it. Coke's a really good company. Target's a pretty good company. Starbucks is a pretty good company. Duke is a really good company. Gen X just did a video on that. If you haven't seen that video, go and take a look at that. He compares it against Nextra, and that's a really good one as well. So that's what's on my watch list right now. I could add those, any one of those at any one time, but I really need to take a closer look at the financials and some of those. So let's go back to my portfolio here. And what kind of determines what I'm going to make a buy or going to add to some of these? What I'm going to look at is I'm going to look at, the 52-week low here and the 52-week high here. And I'm also going to look at the percentages. I kind of a flag set up here for 5%. If it's within 5% of the 52-week high, then it kind of lights up blue here. If it's within the 52-week, 5% of the 52-week low, it lights up blue here as well. You can kind of see that there. And what I'm going to look for is I'm going to go ahead and look for something that's not lit up here in this column, but that is lit up in this column here, if I can find something like that. Now, granted, there's only one right now that's lit up, and that's ExxonMobil. And you can also see a flag lit up here, and that's based off of the good buy PE. So the good buy PE is set up at 21 right now, which is arbitrary. I need to go through each one of these stocks and compare it to somebody else in the industry as well, and come up with a good price, and then set the good buy PE accordingly. So, for example, right here, AT&T, I have a good buy set at 15, but if we set that to 20. We will see the flag set up over here as green. So it kind of just gives me a visual cue that the price is a good price. It's right around the price that I want to buy it, or should be at least looking at it. So let's go ahead and just clear that flag. So another thing I'm going to look at is I might look at beta just to see whether it fits into the overall beta that I'm looking for in the portfolio. So right now the average beta for the whole portfolio is 0.75. The average weighted beta is 0.25. So the other things I'll look at is I might look at the market cap. I might look at beta as well, and maybe I'll discuss those in a future video. But so here's the dividend yield column here, and this dividend yield column I have a flag set up. If it's 3.5% or above, it will be green like this. Because ideally I want to have 3.5% on average across my whole portfolio if I can. Now I'm not quite there. The average weighted dividend yield is actually 3.3%, and it just got lowered because I got rid of Ford, lowered the Altria down, and got into Microsoft, which is a low dividend paying stock. But I'm okay with 3.2%. So if I can kind of raise it up a little bit, or at least keep it above 3, I think I'll be happy with that. So payout schedule, that's just A right here. It basically means it pays out it pays out January, April, July, August. The B's pay out in February, May, August, November, and the C's pay out in March, June, September, and December. Now I don't really care when my dividends get paid out. I know some people kind of try to get their payments right, to be equal if they can, but I don't really care about that. So the other things I'm going to look at is I'm going to look at the payout ratio here, and I have a flag set up. If it's 70% and above, it lights up yellow like this, and there's quite a few in here set at yellow right now. So that's a REIT. That one really doesn't count. But some of these other ones here, I kind of need to go through and double check to make sure they're right. Otherwise, they could be concerning, but you will weight those in your decision to purchase some of these stocks as well. In addition to that, I'm also going to go ahead and look at the 3, 5, and 10-year dividend growth CAGR. So right now, my average weighted 5-year dividend CAGR is 7.75%. That's really pretty good for me. I just started tracking that, and with the help of Gen X for that one. So I think if I keep this above 7%, I think I will be pretty happy with that as these portfolios grow. Now, granted, I need to kind of get these, weighted averages to be closer to what the sectors need to be, and then it'll give me a better idea of what basically my 5-year CAGR is really going to be. So, but right now, 7.75, I'm actually pretty happy with that. So, Chowder rules, I just recently added in there. I need to study Chowder rule a little bit more, but I'll probably do a video on that. Consecutive years of dividend increase. There's quite a few dividend aristocrats in here, and a lot of them have survived quite a few recessions, so that's pretty, look at this one right here. They survived 8 recessions, 63 years of consecutive dividend increases. That's Procter & Gamble for you. That is the reason why it needs to be a staple in your portfolio. That's probably why they call it consumer staple. So out of all my stocks, the 30 stocks here, I got a lot of dividend aristocrats in there, and I kind of did a calculation on those. 66% of my stocks out of the 30 are dividend aristocrats, and that's a pretty good percentage in my opinion. The next closest one I think is probably SO at 19 years, so we're still about 5 years off on that, 6 years off on that. And the other ones, there's an 18 year, so that's PPL, it's another utility. But, I'm not too worried about these. Microsoft, for example, that's 18 years, that's pretty good. So just as note here, this whole purple section right here gets populated by a database that I run once a month, okay? And I'm gonna kind of show you that real quick. And there is some stuff in here that's basically populated by calculations like that there, and like that there. So once a month, I'll go ahead and download the update, and then I will go ahead and run my Python script, which will go ahead and update all these fields right here. And let's just use an example. Let's just say McDonald's basically upped their dividend last month, so a new update came out the following month, and I'm just gonna go ahead and run the script. So let's just say that McDonald's had a dividend increase and it hasn't been updated in the portfolio yet because the database is 1 month behind. So let's just say it was set at $1. Let's go ahead and run a portfolio update on McDonald's. So let's just do a portfolio download here. Okay, we updated the portfolio, and then let's just go ahead and do I'm gonna run my Python script that I created. And basically I'm gonna run it against McDonald's. And if you notice that McDonald's here is set to $1 for the dividend, but let's just say they increased the dividend this particular month and the updated database comes out. I downloaded the updated database, and then I'll go ahead and just run an update against that particular stock. And you'll notice that MCD updates from $1 to $1.25, okay? Now I can run this against all of these in the portfolio at the same time by just not running that -T flag that I have set there. That will actually update every single one of the stocks in this portfolio given by the tickers that are all right here. And that'll take quite a while to run, by the way, probably 15 minutes or so. But I could delete everything in here pretty much and it will just auto-populate. So this whole purple area will get generated just by that database alone. Now the rest of the stuff here, if you're kind of curious about it, most of the stuff comes directly out of Google Finance, which makes it pretty easy, with the exception of just a couple of them I'm pulling from FinViz. So the last thing we'll look at real quick before I talk about, plans going forward is just take a look at the allocations for this portfolio. And this is the portfolio sector weight for the whole portfolio as it stands right now. I'm very light in information technology, but very heavy in consumer staples at this time. And what I pulled is I pulled the VU percentage out here. So this is kind of my baseline I'm gonna go off of to try to match as close as I can. Communications at 10%, mine's at 6, right? So we got consumer discretionary at 9.8, mine's at 7.6 right now. Staples at 7, so I'm way overboard on that right now. Energy at 4, my energy's at 9 right now. And financials at 13, my financials are at 11. So healthcare is at 14, and my healthcare is at 19. So utilities at 3, my utilities at 7. But I'm not too worried about that yet because I'm gonna keep adding on to these positions as we go forward, week after week, could be maybe month after month. I don't know if I'm going to do week after week yet. Because there is commissions free and all that, I might just buy $100 here and there in some of these stocks to get my percentages to be where they need to be. As stocks coming down, if they do come down, some things sell off, more than others or whatever, I will pick up more of those. If they're in my portfolio, I will pick up more shares of those, even if it doesn't fit within my percentage here, because I know overall my percentages will get up to these percentages here. It's just a matter of time. Like right now the consumer staple is at 20, but as the other things grow, that percentage will come down. So I just won't add to those right away. So it's really going to come down to when I can get a deal on some stocks, but in general, I probably will dollar cost average into many of these positions over time as well. I need to get my money working for me. And then I just put another chart here. Income by sector, that's broken out, that's concatenated as well, or aggregated, I should say. And basically $1,681 of passive income right now for annual dividend, and the percentage by sector, and that's the portfolio income by sector. So it's a nice little visual chart there. So going forward, probably by the end of 2020, I want to have these portfolios up to probably about $100,000 total between the two. Now I just transferred another $25,000 into the account. And as deals come, I'm going to go ahead and be getting into more stocks. I need to have some more capital working for me. Many of you might be thinking, it's 2020, stocks are at an all-time high. And what are you doing investing basically 25 grand at one time? And because that's what I did this week. Now I just transferred another 25 grand into those accounts. My only thought is hey, I need to get this money working for me. I don't care if the market drops. If the market drops, I will even put more in the account. Now, granted, maybe the people don't have that option, but these portfolios are lifetime portfolios for me, okay? I'm gonna be living off of this portfolio in early retirement in a couple years, and this is gonna get me there. Now, as my notes bleed off, now I got a lot of money in notes, as those bleed off, they're gonna be filtered and funneled into these portfolios over time, okay? Now, I have quite a bit of cash sitting on the side right now, so why not put some of that money to work for me, right? It's paying, on average about 3%, 3.5% in dividend yield. Okay, that's better than my money market at 1.5% right now. If the market drops, that's fine. I can drip into those lower cost stocks at that time, right? So that's my only thought behind it. And I get maybe some people don't agree with that philosophy. Maybe, just it's 2020, I just want to have a pullback. We might not have a pullback. We might have a pullback for 4 years, 3 years. Could be tomorrow, could be the next day. I don't know when it's going to be. So I have quite a bit of cash on the sideline right now, and I need to put some of that cash to work. I need to get it outside of the money market where I'm getting 1.5%. And since these two portfolios are what I'm calling a lifetime portfolio, okay, I don't ever plan on selling these. At least that's the way I feel. I plan on being these for a long time. This is going to support my early retirement in a couple years. I have a plan for that. I'll be putting a video out soon on my complete retirement plan. So look for that in the next few weeks. But right now, I need to put some money to work, and that's the reason why I doubled down on my portfolio. So I have a goal to increase my dividends up to $2,000 this year. That means I need to put quite a bit of capital to work in order to meet that goal. So it's early in the year. I'd rather put it in now and compound that over the next couple of months and quarters, right? Than wait towards the end of the year trying to meet my goal and just shoving a bunch of money in there, all right? So that's the thinking behind that. So going forward, I'm gonna be putting more money to work and dollar cost averaging, trying to get into more deals if I can. If I see a deal in a certain sector, I'll go ahead and get into those, even if it kind of makes my sectors a little bit out of weight right now. But overall, I will get to these percentages as close as possible. I will periodically check the VU and the percentages to make sure I'm close to those. So these are my dividend portfolios of a lifetime. And what I'll probably end up doing is doing a once a month portfolio update on these. When I get paid my dividends and all that, I'll just go ahead and throw a quick update, maybe some stuff I bought, if I add any new positions, and the dividends that I received. But so that's it. If you have any questions, comments, or concerns, please leave a comment below. Any questions, leave it below. So go ahead and please like and subscribe, and we'll see you next video. Thanks for watching.